G'day guys, and welcome to the weekly VEMA Trader video. Now, I say weekly, I did actually miss last week. I got food poisoning and took a few days to recover, so sorry about that one. But hey, we're back in action this week. And today I'm going to be talking to you guys about momentum. And the reason I'm going to be talking about that is it was the first thing I saw when I logged on and checked the Bitcoin chart this morning. I could see that momentum was starting to drop off in terms of the bullish momentum. So, in this video, I'm going to explain to you guys exactly what I saw to indicate that that was happening. And I'm going to show you guys a few different ways that you can spot that, and then how to use momentum indicators to spot divergence, and then how to use that to help you in your trading. So, without further ado, we'll get started. Okay, so the first thing we need to establish is what actually is momentum. So, momentum in the market is essentially showing you kind of like a combination of strength and direction. For any of my physics nerds out there, they will know that momentum is a vector, right? It always has a direction as well as a magnitude. Don't worry if you don't understand that. It's not anything you need to understand. But momentum in the markets, the easiest way I think to think about it is to look at pivots. And when you look at pivots, you see between the pivots, the market moves, right? Market moves up, market moves down. Market moves up, market moves down. Market moves up. You can tell that if we compare two moves up, right? So let's look, we got this move down here, and we have this very small move up. Compare that to this. Which one of those would you say has more momentum? I think most people would say the second move, right? The second move is showing a lot more bullish momentum because it is essentially just a bigger move. That is really the key to it, right? It is a bigger move than the previous move, so it has more momentum. That's really the simple way to think about momentum, is the size and strength of the move. So, what do momentum indicators tell us? Well, basically, rather than us having to go, okay, this move was about that big and this move was about that big, so that second one has more momentum, momentum indicators just try and make it really easy to see visually. So the three most common momentum indicators are RSI, MACD, and CCI. Now, all of these are essentially telling you the same thing or very similar things, right? There will be some distinctions, but very similar things. The difference is how they calculate momentum. So you can see the RSI, this 14 here. My mouse highlighter is not working for some reason. So the 14 on the RSI, what that's telling you is your RSI is measuring back 14 candles from the current candle, or from, if you're looking back, from that point in time, it's measuring 14 candles back. So from here, it would be looking at all of these candles. Let me move that out of the way a little bit. What am I doing? Let's get rid of these for 2 secs. So at this point in time, the current price, it is saying, okay, compared to these last 14 candles, what is the momentum right now? And it is showing, okay, momentum is dropping off, or bullish momentum is dropping off, because you do have bearish momentum as well, but momentum is dropping off. It's still more bullish than bearish, right? So as a general rule with the RSI, 50 is kind of like you can see, right? It has acted really well as support and resistance, and it's kind of like a bias, right? If RSI is above 50, price is generally moving up over the average, over the last 14 candles or so. If it's below, price is generally moving down. So, how do the other two differ? I won't go into MACD because, to be completely honest, it's the one that I understand the least. When I first, I've done 2 RSIs. When I first learned trading, I did, learn what MACD was and how it all worked. But I haven't used it for years, and I've kind of forgotten a lot of it, so I'm not going to go into it too much. Where RSI differs to CCI, you can see that CCI is looking at 20 candles. So it is looking further back rather than just looking at the last 14. It is looking at the last 20. The other thing that they differ in is the formula used to calculate the value. So you will see RSI, no matter how far back you go, will never go below 0 or above 100. It cannot, because the formula that it uses to calculate its values is essentially normalized. I don't know if that's the right word. I think normalized usually means 0 to 1, but essentially it's normalized to 0 to 100. So you cannot get a value outside of 0 to 100. CCI is not normalized. So in theory, you could get a value on the CCI of 1,000. It would be extreme moves, but you could possibly get 1,000. You can see that, recently The CCI on this chart got to 356. You will never see that on the RSI. It doesn't actually mean much, but it just shows, okay, even though these things are showing you similar things, they're both showing you momentum, they use different formulas to calculate it. They get different results. And they look at different lengths. Now you can change that. You can come to your settings. Let's say you wanted to map this to 20. You can come in there and see. And you can see it still differs, right? Even though they're looking at the exact same time frame, your CCI and your RSI still differ, even just when you look at the movement of the line, because they use different formulas to calculate their values. So I'm going to just use CCI in this video because it's the one that I prefer, but I just wanted you guys to understand what momentum indicators actually are and what they are telling you. They are pointing out, okay, this move is bigger than this move and bigger than this bullish move. And you can see that because the momentum indicator really starts to ramp up. Okay, so that's all well and good. We now understand what momentum is, what momentum indicators are. How do we use them to help our trading? So the most common way to use momentum indicators in your trading is probably spotting divergence. It would either be that or oversold and undersold on the RSI, which you know what, I'm going to add in as a bonus in this video. Let's do it. So, because it's really quick and easy to explain. With the RSI, a really easy way to use it for your trading is oversold and overbrought conditions. Overbrought would be outside of 70. So you can see this purple, I can't think of the word for that, channel. This purple channel is from 70, if I can get that to line up, from 70 to 30. And so what happens is if price gets outside of that, it's kind of showing, okay, we are seeing extreme momentum right now. So you can see here, price got very high up out of it, got up to just under 80. What that's saying is, okay, there is a lot more buying pressure now than there has been, over the past 14 candles or so. And it kind of indicates there might be a reversal coming soon. So it doesn't guarantee it, right? Price could have kept heading up, and this could have kept getting more and more overbrought, sorry. But it kind of says, okay, this trend may be getting close to exhaustion. At some point, things turn around, right? Price doesn't go one way forever. It can go to zero. It can go down forever until it hits zero, but it can't go up forever, or at least, we have never seen price go up forever on anything that I've ever come across. So what happens is when it gets outside of that range, it is showing, okay, this is getting overbrought or this is getting oversold, and it is an indication that the trend may have a reversal or just a retracement. It doesn't have to be a reversal, but that you may see a pullback coming soon. So that is how to use the RSI with overbrought or oversold. I find divergence, you can get divergence on the RSI. I find it much easier to spot on the CCI. So we're going to use the CCI for this example. And the reason that I'm bringing you guys a divergence video today is there is actually divergence happening right now on Bitcoin on the dailies. So what is divergence? It is essentially where the price action and the oscillator start to disagree. They start to show two different things. And what I mean by that is if you look at market structure on the price action right now, you can see that Bitcoin is making higher highs. It made a higher high here, and it made a higher high here. But if we take a look at the oscillator, we see a higher high on this huge spike here, and then we see a lower high. It doesn't actually agree with what price action is doing. And what it's showing you there is essentially, okay, this move was much, much bigger than this move. And that is why you have a huge spike for the first one, because it's a big upwards move. And the second one, which is being compared to that first move, it is going, okay, it is much smaller. There was a bit of upwards momentum, but it is much smaller. What that's actually telling you is, okay, price is still heading up, but there is less buying pressure, right? We got pushed a huge move up the first time. We've come back. We're not seeing that huge move come in again. Yeah, we've made a higher high, but it's really only just, right? We've only gotten a little bit higher compared to here where we moved way up. Yeah, that is only a little bit higher than there, but the length of the move that it took to get there was much larger. That's a pretty small move, that second one. When you start to see divergence, an easiest way to see it is to just use standard trend lines. Let me get rid of all of those. So I can show there, okay, we are getting higher highs on price, but we are getting a lower high on the indicator. So you can see that divergence, right? They are diverging away from each other is essentially why it's called divergence, probably. I have no idea. But yeah, the lines are diverging. They are moving away from each other, one on the price, one on the momentum oscillator. Again, what that starts to indicate, it's not a guarantee that there will be a reversal, it's not a guarantee that there'll be a retracement, but it kind of suggests, okay, it might be time for this to cool off a little bit. This might be about to have some sort of a retracement, some sort of a reversal, and you can kind of start to expect bearish movement, right? Now, the opposite is also true. You get what's called bullish momentum. Excuse me. And a perfect example of that is here. So here, we can see price was making lower lows. We get a lower low. We get another lower low. We get another lower low. But on the momentum indicator, I mean, it's a bit harder in this example because there is 3 of them, but we got lower low, and then we got higher low. And we'll just call that second one an equal low. I think it's barely, we'll just call it equal. But you're seeing divergence, right? You are seeing, oh, that throws out my divergence theory, doesn't it? Because now these lines are converging. They're coming together. But anyway, it's made for some other reason. I'll find that one out later. So what you are seeing is opposite things happen. Price action is forming lower lows. The momentum oscillator is forming higher lows. They're not agreeing. And in the same sense as what we showed before, what it's actually showing you is, okay, these downward moves are getting smaller. This first move was very big. This move, much smaller. This move, much smaller. Although you can see the reason that these are equal lows is these 2 moves. I need to figure out a better system of drawing. But these 2 moves are very equal size, right? If we, in fact, measure that like that, I think we'll find that they are, there you go. So from there to there, what's a good way of doing this? Something like that, you know. It is essentially showing that those 2 moves are almost identical in their size. Whereas if we compare that to this move, you can see that this is not getting anywhere near the top, which sort of shows why that was a big dip and then followed by these 2, right? Because they're being compared back to that. So this one here, this big move down, would actually be being compared to this downward move, which is why it's such a large spike, because that was a very small move. If we measure this one up, you know, very small move down followed by a big move down. So then you see there is a much bigger drop on the CCI on that second move, because it's comparing it back and saying, okay, there's a lot more momentum in this move, a lot more bearish momentum. And then after this big drop, we see a lot less bearish momentum. So even though price was heading down, it was forming lower lows, we're seeing less bearish momentum. We're seeing less selling pressure. And it just kind of indicates, okay, selling pressure might be getting exhausted. We might see buying pressure coming soon, which is exactly what happened, right? We had that divergence. We had a big, I wouldn't call it a reversal, but a big retracement. Big retracement following that. You can see bearish divergence again here. So from here to, I mean, this is just ugly. It's hard to draw. But, you know, something like that. From there to there, and from there to there, then you see, okay, we got a retracement. Got a bit of a bounce. So that is divergence. That is how, in fact, I'm willing to bet, if we go and look, right, I'm willing to bet there's a good chance there's going to be divergence here. So let's vertical line that, and let's head up and see what we can see. Oh, I shouldn't have taken that bet. There is absolutely not divergence there. So that would be a case of where it's not divergence. Now, you do get things like hidden divergence, and you also get confluence. This would be confluence, I believe, although I'm much less well-versed in confluence and hidden divergence than I am in just typical divergence. But here, they're kind of agreeing, right? You are seeing, okay, price is forming a lower low, and you're seeing that the buying pressure is reducing. So if we measure these 2 moves, we have that move compared to that move. You can see, okay, the second move is much smaller. There is much less bullish momentum in that second move. And in fact, that's probably a good indicator that price is going to head down, right? It failed to make a higher high, and the buying pressure was so much smaller on that little retracement. It kind of shows selling strength, right? So at the end of the day, momentum is essentially a measure of strength of the move. Strength of buying pressure, strength of selling pressure. So that is bullish and bearish divergence and how to find them with the CCI. I won't go into RSI and MACD. It would typically be the same, right? It's just a little bit harder to spot on those. CCI is probably, in my opinion, CCI is the only indicator that I ever do use. I very rarely use it. It's the only one that I do use. In my opinion, it is by far the easiest for spotting divergence. Okay, so that's all well and good. We now know what momentum is in the markets. We know what momentum indicators are, what they look like, how to spot divergence on them. How do you actually use that in your trading? There are a couple of different ways. I'm sure there's infinite ways. There's a couple of different ways that I know of. One of them is to get a bias. Now, anyone who's watched my videos will know that I am a huge fan of bias. I basically always talk about it. How to use divergence to get a bias is you would start looking for trades that agree with your divergence. And you could do the exact same thing with the RSI being overbrought or oversold, right? What you would do is you would go, okay, I'm currently seeing divergence on the daily, right? We're on the daily time frame right now. I'm seeing divergence on the daily, which means I think that price may reverse soon. We might see some bearish moves coming soon. I'm going to take that bias, so I'm going to go to the 4 hour or the 1 hour, and I'm going to look for shorts. I want to trade in the direction of my bias. I'm going to try and catch some of that downward move that I think is coming. So I'm going to look for shorts on the 4 hour or the 1 hour, whatever time frame you want to do it on. That is one way to use divergence, is to get a bias. To do that with the RSI, you would basically just go, okay, you could look for divergence again, or you could go, okay, if the RSI gets above 70 or 80, you can pick different levels to what the indicator is default set to. But if I am seeing price be overbrought, which would be above 70 on the default indicator, then I'm going to look for shorts on the smaller time frame. That is how you could use the RSI to get your bias. The other way to use it is more direct, right? Is as a confirmation, an entry confirmation for your trades. So let's say that I am looking to short from alpha because there's a supply zone there. Let's say that it might also be a trend line or fibs or whatever else we want to look at happening there. Currently, price is making higher highs and higher lows. We are seeing higher high, higher low, higher high. So this trade might go against my bias. But what I could do is, if price gets up to here and I'm seeing divergence, that might be enough entry confirmations for me to tell me that I want to get into a short, because I'm seeing a level where I think there's going to be resistance. I'm seeing the bullish momentum dropping off. I'm seeing the selling pressure increasing because I've got my divergence, right? That is telling me that bullish momentum is dropping. What I could then do is I could set the condition alert only. What that's going to do is it's going to say, okay, if price gets up to alpha and meets my entry conditions, which at the moment is just crossing alpha, there's nothing else to it, then let me know. Send me an email and I can come back and look. If in that case I was getting the divergence that I'm looking for, so let's say price is something like that, which would probably look something like, it's always really hard to convert that to momentum, but something like that, let's say, I could come back, and if I see that, then I go, okay, I've got that divergence that I was looking for, right? I'm now seeing 3 drive divergence, which is typically even stronger than 2 drive divergence. By drive, I just mean the number of spikes, so, right? Well, it's probably easy to see on the price action. That would be the first drive. That is the second drive. That was way too big. That is the second drive, and then that would be my third drive. If I'm seeing 3 drive divergence, so I'm seeing that bullish momentum dropping off at a level where I think price is likely to reject anyway, that might be the entry confirmation that I need to then take that short. Righto, so there you have it, guys. That is momentum. That is momentum oscillators or momentum indicators, and that is divergence, how to spot it and how to use it to help your trading. Let me know if you guys got something out of this video. Let me know if there's anything that you want me to cover, right? I am always open to suggestions for what videos you guys are after, what could be helpful to you in your trading. Have a great day, happy trading, and I will talk to you very soon.